Hey, it's jobs week. This is a big week, a kind of a big deal every month, right? When we see the ADP report and then the BLS, the Bureau of Labor Statistics government survey of jobs, job creations, labor participation rate, and unemployment rate. Big market mover week. So let's watch this. Let me tell you about that a little bit. Wednesday is the ADP report. ADP, of course, is a large payroll services company that is so big that they have a footprint across the entire country and have been able to gather enough data every month that they can provide their own report that market participants pay attention to, bond market participants and stock market participants. Typically, that report seems to swing wildly from what the Bureau of Labor Statistics report is. They don't match up very often. Maybe a few months out of the year they're close, but otherwise they're really far off. So it's a big deal because the market moves based on the ADP report, and then it moves again on Friday when we get the BLS report. So we're going to have to watch this closely, and then I'll give you an update next week on what happened and how that moved the market. But let's talk about this here just a little bit and look at the charts. This morning, the 10-year Treasury, which again is the leading indicator, right, for mortgage-backed securities, where the 10-year goes, typically mortgage-backed securities go and mortgage rates go. The 10-year, unfortunately, is popping up above this 4% yield level of resistance. It's been a ceiling over the past week or so, 4 days, 4 trading days or so, has not broken above that since well, since back before, since back when the ADP and the BLS reports came out last time, right? That's when it popped up there. So when the yield is higher on the 10-year Treasury, that means that 10-year rate is higher as well, and that's a leading indicator for mortgage-backed securities. The S&P is down a bit, and then of course we have the mortgage-backed securities, the 30-year mortgage-backed securities, kind of following suit, unfortunately. So on this chart, it's the opposite of the 10-year. Down is not good. Down is the price is weakening, which means that the rate is rising. So over the past 2 weeks, we've seen the rate steadily deteriorate since we got that nice boost in mortgage-backed security pricing, right? Based on the inflation reports that came out a couple of weeks ago that were fantastic, that showed inflation easing on the CPI and also on the PPI, so the consumer and the producer price indexes. We showed some improvement in inflation, right, which is good news for interest rates. So the price popped up, rates came down a good 0.25% to 0.5%, depending on the program we were talking about. But since then, it's slowly kind of given back its gains, with concerns about certain sectors of the economy not slowing down much. And then right now, it's really kind of considering dropping below this Fibonacci floor of support. If we get strong job numbers again from ADP and then from BLS, we could again see it down in this range where it was a couple of weeks ago, unfortunately. So the trend, the momentum is going that direction. We do have this Fibonacci level to hopefully hold, but it might not, right? We might see some even worse rates by Friday. So my suggestion is, if you are in a position where you are trying to close on a mortgage anytime here in the next 30 days, probably a good idea to go ahead and lock in, take advantage of where we are now, because it could easily get worse. There's a possibility it could get better, of course, if we have worse unemployment numbers than expected, lower unemployment numbers than expected, unemployment rate ticks up again. We could see it turn around. But boy, it's a hard gamble right now. 50-50. You just don't know which way it's going to go. And ADP being a wild card could throw it off for a bit. So that's my suggestion. That's what's going on this week. Jobs week. We'll be in touch next week. And I hope this helps you at least make some good decisions based on what you're trying to do for your interest rate locking situation and where kind of things are headed for your planning.